Hey, folks, welcome back to the Traders for a Cause podcast. I have a special guest this week. He is the owner of Rivera and Company, and you might know him as the Trader Tax CPA, Mr. Brian Rivera. Welcome to the Traders for a Cause podcast. How's it going?
Zach, thanks for having me. This is the optimal time during tax season, so I am super busy, but I figured I would take a few minutes out of my day to come chat with you and just talk about some of the things that I'm seeing on my side of the fence.
I feel so honored that Traders for a Cause has made your busy schedule, because I know it must be crazy this time of year.
Yeah, it's a good problem to have. But
Absolutely, especially after 2020 with I'm sure the onslaught of new traders that have come in and probably don't know a thing about it.
I think records are meant to be broken, right? I think there's a record number of new day traders in the market. I think Robin had a record number of new accounts open. So day trading was something that was easy for a lot of people to I guess try, kind of during the pandemic because they were at home, right, collecting unemployment or
Sure.
doing whatever. So I think day trading was a good fit for a lot of people.
Sure. So let's kick it off with a kind of an easy question that I know a lot of people are curious about. Talk about some common misconceptions when it comes to trading and income tax, and where do people start when they get into this business?
Yeah, so that's definitely a fully loaded question. I think there's first of all, before I get started, let me go ahead and say that anything that I say, I wouldn't say it's individualized tax advice. So I'm going to talk very broad because each person's facts and circumstances are different. And so that's why I always recommend to book a consultation, talk to a CPA. But I'll talk high level and I'll talk trends that I see. But one of the biggest misconceptions that I see is that I think sometimes when people start trading, they automatically think that they are classified as a trader or an active trader under what the IRS guidance is. When really, there are certain behaviors or patterns that you got to meet in order to be qualified as a trader. And once you become qualified as a trader, then you get a bunch of different benefits that include, being able to deduct your business expenses, electing mark-to-market accounting. There's a variety of things that you get when you become qualified, but at its onset, just because you're behind a computer, just because you're behind a keyboard, you're placing trades, that doesn't necessarily mean you're a trader. You got to hit the certain hacks to become an actual trader. Hopefully that makes sense. So that's number one. So number two is, I think sometimes people try to calculate their own tax liability. And I think sometimes they assume that the gains that they make from trading, are subject to self-employment tax, and really it's short-term capital gains. So you don't have to worry about all that other stuff too. So there's a lot of assumptions that people make, but again, I could talk about this for the next hour, so I don't want to go too far in the weeds, but high level, that's kind of what I see.
Got it. When you are an independent trader, if you have decided to do it full time, what are things that you can deduct that people might not realize that they can, that can be a part of your tax plan?
Yeah, so if you look at the the IRS guidance, basically when you qualify as a trader in securities or a business trader, you can deduct anything that is ordinary and necessary to execute your trading business. So some of the things that I see is, people are a part of, let's say, chat room subscriptions, they pay for education, they've got market data, they got scanners. Traders use a lot of different things, to execute, their day-to-day operations. And so there's a lot of business expenses that you can deduct just as a part of the normal course of business. Or maybe you're a small cap guy, you like to short some of these, these penny stocks, right? Super volatile, right? So you pay a fee to borrow shares from your broker to participate in that trade. And that's a huge expense that a lot of people are missing out on if they don't understand that, they're allowed to deduct those things.
Very interesting. Do you have to be incorporated to maximize these deductions that you're talking about?
You don't actually. So a lot of people think that you got to be inside of an LLC to leverage business expenses when you actually don't have to. So as long as you hit the criteria, very high level, it is, you place at least 720 trades in a 12-month window. You place a trade on 75% of available days. So the equities market is open, 252 days in a year. So 75% of that is 189. So you got to have a trade on 189 days. There's a couple other things, just spending at least 4 hours in the markets. You got accounts over PDT. So if you hit all those rules, you could call yourself a trader. And how you know that is going to be based on your 12-month picture, or at the end of the year when you can, review your data and assess to say, okay, yeah, I meet the criteria. So once you meet the criteria, you are now allowed to deduct your business expenses. So the IRS won't give you a stamp of approval. You won't get a great job certificate in the mail. Literally, it's just you have to prove that you met the criteria as of the end of the tax year. And once you do that, you can deduct your expenses. Now, when you get inside the LLC, go ahead. Sorry.
I was going to say, talk to me briefly about the difference between a trader that has a $5,000 Robinhood account and a sophisticated trader who has a, $100,000 or $1 million account at, a more active trading or sophisticated trading firm.
Yeah. Or we can even throw in the hedge fund. I think he had, what was his leverage? I think it was Bill Huang. Not much different, right? But
sure.
I think at the end of the day, if you compare, just apples to apples, they both have access to the market, the ability to execute trades. But I think when you look at the professional trader, retail trader versus the Robinhood guy, they're going to be limited, one, to the pattern day trader rule, right? So they won't be able to achieve trader status because they're only allowed to execute 3 round trip trades in a 5-day window. So it's going to be very hard for that person to hit all that criteria. Now, if they spread their capital, let's just say they were at Robinhood, Webull, what else is there? There's a couple of them other out there. So if they spread their capital, then maybe they could hit, the 189 days, the 720 trades. But with just one account, I'm not sure they'll be able to do it.
So in your opinion, for people who are trying to get into this business, is there a big advantage in getting over that PDT rule from an accounting perspective, or is it just a matter of, being able to be more active as a trader?
From an accounting perspective, or from a tax perspective, I would say that once they're over the PDT rule, once they qualify for trader status, then you unlock Pandora's box, and that allows you to, one, deduct your business expenses. So on average, I'll see traders deduct somewhere between $8,000 to $14,000 a year in business expenses. And then if you're a short seller, it goes way beyond that.
Of course.
And then the other thing is you unlock the ability to elect what's called Section 475, which is mark-to-market accounting. And once you get those two things, you're getting probably, I would say, about 80% of what it means, to leverage the tax code. And then from there, you can get into these entity structures, which I don't want to confuse everybody, so I'm not going to go too deep into that. But there are some additional deductions that you can unlock by trading under a business.
What's give me like a gold nugget? Like what's something that everybody needs to know when they start doing this that if they don't know, or if they're ignoring it, they're being completely foolish?
Watch those. Absolutely watch those. I don't know if you saw that article that was circulating, maybe it's like a week or two ago. I got a bunch of emails. It was going off the hook, and everyone was worried, like, oh my gosh, this guy, he only made 45 grand, but he's got a tax bill of 800,000. So if you're a new trader and you don't know what a wash sale is, I highly recommend get yourself educated, make sure you understand. Just go on Google, type in wash sale. I got stuff on our website. I got stuff on YouTube. So there's a lot of information out there to help you understand what it is. But at its most basic, most infant definition, if you buy and sell a stock in a 30-day window and one of those trades is a loss, and you turn around and re-participate in that stock, congratulations, you just flagged a wash sale, which gets disallowed for tax purposes. So if you keep trading that stock over and over and over, and you never sit it out for at least 30 days, that wash sale is going to accumulate, and it's going to become massive and massive. And so this particular trader did not sit out of this stock, and he kept trading all the way to the end of the year, which now he has what's called a wash sale deferral. So the loss got deferred into the next tax year. And that is why his tax bill is higher than what he actually made.
That's insane. So if I remember correctly from that article, he made, I guess, $60,000 at his regular job. He made 45 grand trading, and his tax bill is potentially $800,000. And there's no way for him to fight this or get out of it. Like this, it's legitimately going to basically screw him.
Unfortunately, I didn't see the final tax. I don't know if his tax bill was 800 or if his gain was 800, but right now, unless he can prove that there was an error in his broker reporting, like the 1099B that was released. He doesn't have, I mean, there's not much to do. The law or the tax code or the tax laws were there for a reason. And you can thank the hedge funds, because that's the reason why that law is there in the first place, the wash sale rule. Because what happens is there's something called tax loss harvesting, right? So, these hedge funds, what they'll do is they'll look at their portfolio and say, hey, great year, I made a couple $1,000,000, right? So let's scan to see if there's any stocks that we have losers, right? We're holding the bag and we want to get rid of it. So they'll kill the loser and it brings their overall net income down, right? They just get rid of the stock. Well, they know they want to, let's say it was Netflix, and they still want to stay long that stock. January 1st, they'll sell it right before, or December 31st, they'll sell it right before the end of the year, right? To bring down the tax bill. January 1st, they'll turn around and rebuy it. That's when Uncle Sam came in and said, hey, no. You can't recognize the loss and then go back and participate in this particular position. That's considered a wash sale. And so that's actually how it came about.
So it's a fully legitimate thing then. I mean, like they're just trying to
absolutely.
prevent people from cheating the system. Now, would it have
As a
mattered?
day trader, you're flagging this stuff every single day. So it's not like,
Sure.
It's not like, if you're an investor, you can flag it at the end of the year. But as a trader, you got these all the time.
So the way that he could have avoided this is basically just let it go by the beginning of December, and then
he just needed to sit out. So he needed to figure out, okay, especially the guys who trade the same thing over and over again. So there are momentum traders who will trade like the FANG stocks. They'll trade Facebook, Apple, Netflix, Google every single day, right? That's all they trade. In that situation, you're going to flag wash sales. So you'll need to sit out of those names for at least, I say 31 days to be safe. But if you're a player where let's just say you trade a stock, it's hot for 3 days, and then you don't actually look at it again until 6 months from now, you probably don't have to worry about that. But it's for the guys who are really buying and selling the same things over and over and over again.
So it would have made no difference how much what his P&L was for the whole year. That was completely irrelevant to this situation, right?
Because he had basically a wash sale deferral. So people will look at that column on their 1099, and that number is just an accumulation of the year. So where the problem lies is if it straddles tax periods. So if you flag one in December or January, that's the key time that you really need to pay attention to.
Got it. Very interesting. So talk about like a massive loss. Like, is there any way to leverage that? I mean, obviously it's emotionally devastating, but can we kind of like find solace in the fact that could help out on the tax side?
Yes. Yeah, there is one thing you can do. So funny is when you have a massive gain, there's no pity, right? Because you made a lot of money. But if on the loss side, you got to be careful again. So there's something called the capital loss rules, right? So if you if you have a loss on the year, let's just say you lost 100 grand day trading, and you are not a mark to market trader, you're a regular, you didn't elect it, right? You didn't elect mark to market. You lose 100,000, you can deduct $3,000 on your tax return. So if you've got another business, you've got some other type of income, W-2 job, something like that, it'll offset that $3,000. Rest of that gets carried into the next tax year. So you carry 97,000 to the next tax year. So you fast forward to the next tax year. If you make money, let's say you make 97,000, congratulations, you don't pay any tax because you had a capital loss carryover. If you don't make any money, you write off another 3,000, which brings that number down to 94. And you keep carrying that until you recognize the $3,000. Now, if you are a Section 475 mark-to-market trader and you lose 100,000, well, you get to take that entire write-off in the current year. So if you lost $100,000 day trading, boom, as long as you qualify for trader status, as long as you've got the 475 election, you can write that whole entire amount off on your tax return.
Interesting. Would there be any advantage to go one way over the other? I mean, like
absolutely. If you are an active trader, you want to make sure, I'll take a step back. If you're not a long-term investor, so if you have a 475 election, everything gets marked to market as of the end of the day, as of the end of the tax year, right? So if you have securities that you want to hold for investment, so these are things longer than 12 months, you get the long-term capital gains rate, which is a lot better than the short-term capital gains rate. You want to be careful. It's because everything you own is going to get marked to market unless you can specifically identify the securities you have held for investment versus your trading account. So the best way to do that, maybe you trade in an LLC and then you invest in your name, or you trade in your name and you invest in an IRA or 401k type account. So there's ways to segregate your investments from your active trading. So
Very interesting. Now, talk about the advantages or disadvantage to having a trading organization or an LLC versus trading as an individual, like the difference in the structure.
What is the advantages and disadvantages of being in an LLC versus not?
Yeah, yeah. Essentially, trading as an individual versus trading as an actual
Mhm.
licensed business. Like,
Yeah. So, I mean, that's a very deep question. I'm gonna touch on it. Probably the biggest thing you're gonna see is that when you're an individual, you don't have earned income. So you're not paying Social Security, you're not paying wages. So if you want to get inside of a retirement plan, you won't be able to do that if you just trade in your name. So you actually got to have wages. So one of the cool ways to do that is you get an LLC, you get a tax as an S corporation. Under an S corporation, you can create earned income, i.e. W-2 wages. So if you're a trader, you make 500,000, pay yourself 150 grand. Congratulations, you got W-2 wages now. Now that you have that, now you can contribute into retirement plans. Now you can deduct your health insurance. You can't do that stuff if you're not inside of a business. And the other thing is, the let's just say the S corp, it has one of the best retirement plans that, in America, right? It's the solo 401k, because you're the only employee in the business. So under a solo 401k, I believe for 2021, you can contribute up to $58,000 in the form of business deductions if it's a solo 401k traditional. There's also a solo 401k Roth option that you can also do the same. So that's how traders who make too much money can get money. I'm going into the deep, the stuff I'd go over on my consultation, but that is how traders are able to get money into these retirement accounts. Because a lot of times, if you make too much money, you can't put money into like a Roth IRA or something like that.
cool.
Yeah. Yep.
So the idea is essentially to create a corporation and pay yourself as an employee
Absolutely.
to get those benefits.
To get those benefits. Absolutely.
What are your thoughts on the? I feel like I've had this conversation with so many traders about
Yeah.
the fear of a financial transaction tax and what that could do to the industry. What are your thoughts?
I'm almost curious to see what the consensus you've got from the guys on the other side. I mean, I'll give you my thoughts. But I'm almost curious to see kind of what you're seeing, what you're hearing from like the trading community.
Well, I will tell you that I think that the fear has been out there a long time.
Mm-hmm.
I think it was Elizabeth Warren or somebody who had talked about how they felt like they needed to try to capture revenue from the active trading community. So the fear has been there a long time. Now,
Yeah.
what's really behind it? I'm not really sure. I
Yeah.
do think, based on some conversations that I'm having, that the whole debacle with GME and just the public light that was shown on that whole situation
Mm-hmm.
has attracted more scrutiny.
Absolutely.
And I think that a lot of traders are nervous that because of how that's kind of put it in the public eye, that they might do something that's going to make life difficult, at least in the short term, until
Yeah.
traders can adapt and figure out a way around it. So I think that's the consensus. It's like they're kind of cautious. They're feeling it out. But again, like I've been hearing this for years, so
Mm-hmm.
I don't know how much
Yeah.
is behind it.
Absolutely. I would agree. What's interesting is, Robinhood is, probably the biggest retail, at least at that time, was the biggest retail brokerage in terms of like the everyday, investor. Maybe not the active trader, but maybe just everyone's got a Robinhood account. And so funny is that on Capitol Hill, I think the big players in Robinhood were actually a proponent for it, which what I thought was pretty interesting. But what I think, and honestly, I mean, I'm not a betting man, but if I was a betting man, I don't think it'll go, because I think it has huge ramifications in terms of liquidity in the market, a lot of HFT funds. I mean, there's a lot of big dollars in a lot of these different firms on Wall Street. And I feel like, to take a chunk of that away would be huge. Now, just doing the math, right? So let's just say the financial transactions tax is 0.001, or I think was some of the numbers that was floating around. So if you trade, your sales proceeds are $1 million in a day, that's $1,000. I know traders that do that in 5 minutes, so it's kind of like,
Right.
if you start thinking about the numbers, like, wow, this could be pretty big. And so I don't really know, because like you said earlier, it got some early rumblings like in 2016. I think this was like maybe when Senator Sanders was kind of on the trail. He was kind of throwing it out there. Senator Warren, and then the VP was also talking about it. But then I didn't hear much from Joe. I mean, I didn't hear him say much about it. But then about, I don't know, 2-3 months ago, I saw a draft bill. I'm like, oh, wow. So they're serious about this. So now I'm just like, I don't know. I hope not. I mean, I think long term, if it does happen, it won't be good for the market. But I think for now, enjoy it while it's here. And then you can't worry about tomorrow, right? You just focus on today.
When I started out the day trading community, and when I say day trade, I mean like the guys that are, physically pulling levers and placing trades, they really had it out for HFTs. And like people went on tirades about how HFTs are ruining the market and all this, and the talk of a financial transaction tax would have basically been curtains for HFTs. I mean, like, it would have been the end of them. I think that opinion has kind of shifted a little bit. Like, I think that traders are appreciating the liquidity that HFTs are bringing to the market. And so maybe sentiment has changed a little bit, but
right. I mean, if you think about it, you're buying, like, you think about a house, right? A house is $500,000. You're buying and selling a house multiple times a day in 2 minutes, right? Like, you can't do that, without, with a liquid, market. So it'd be interesting to see, again, if I had to vote, I'd say right now, I don't think it's going to happen, but again, it could change in 2 weeks.
So do you trade yourself, Brian?
I do, actually. I do. I trade a lot outside of tax season. See, right now it's like hot and heavy. And so, if I see something like a layup, I'll get in there. But right now I'm really just focused on mentoring, developing my staff, making sure we're providing quality tax returns, all that good stuff. But I do get in there and trade. I like to trade, large cap stocks, options, and actually having a really good year. March was a little rough, but January and February was really good. So this has been a good year for me.
Fantastic. So are you taking new clients?
Yeah. So anybody who's coming on board right now, typically we're asking them to just go on extension, and then we will tend to it kind of after the May 17th deadline. Because right now we're absolutely jam-packed. So a lot of them, if they're okay with following an extension, we can get to it after the May 17th deadline. But as of right now, we are absolutely slammed. I mean, it's a good problem to have, obviously, but
of course,
if that is you, then yeah, we could definitely, get you going right after the May 17th deadline.
All right, sweet. So somebody who is, say, locked up with another accountant that may not have your level of expertise on trading, is there anything that you can give them, kind of like just a tidbit to make sure that they're doing the right thing, that even if their accountant's not knowledgeable, that they don't get
I see this a lot, because a lot of times, the CPA relationship is, they're looked at as probably one of the more trusted advisors, in someone's kind of circle, right? And so if you have a relationship with an accountant, a lot of times it's long term. It's not just a 1 year relationship. So what'll happen is, one is I'll usually point them to I have a lot of content at Trader Tax CPA where I just have a lot of different blog posts that go through a lot of the stuff that we've discussed today. I've got the YouTube channel going, and also I do consulting. So I do a lot of consultations with a lot of different people all across the US. So I have a calendar link where people can sign up. And a lot of times I'll do calls with not only the trader, but also their CPA. And so sometimes after talking, if they decide, hey, you know what, this is a little bit above my pay grade, I'm going to go ahead and refer this out, they'll do that. Or, we'll just figure out if I can get them comfortable in answering their questions. And so there's a couple ways to do that. And I do have a lot of other clients too, where maybe they trade in an LLC and then their CPA handles the personal taxes or something else. And so that makes it easier, right? Because then we can do the separate entity return and then give them the K1s, and then they take it to their guy, and they'll go from there. So
absolutely. Cool. So where can people find your content?
TraderTaxCPA.com is the website. YouTube, I'm pretty active on there. So that's Brian Rivera CPA, where I talk about personal finance, entrepreneurship, investing. And then Twitter, TraderTaxCPA. And then same thing with Instagram, I think it's Brian Rivera CPA. I'm not super active right now, to be honest, just because I'm so busy. It's a good problem to have. But usually outside of tax season, I'm pretty active with that. So
fantastic. Well, you have participated in Traders for a Cause events in the past, and I want to thank you for that. Thank you for supporting us, and thank you for coming on the podcast and offering this wisdom, especially in such a busy time of year for you.
Yeah, no problem.
And we do have some events coming up. We'll be announcing one shortly in the spring, and maybe it'd be appropriate. I believe it's going to be after tax day. Maybe it'd be appropriate for you to come on and share some more nuggets of wisdom. I think that would be really beneficial. And
you guys doing virtual this year or in
yeah,
person?
so definitely virtual in the spring. Vegas is kind of still up in the air, but I think that we're leaning towards pushing back to 2022 just with the uncertainty. So, but when we do go back to Vegas, I hope that I can count on you coming out there. That would be be a blast for
I
sure.
did go maybe like 2 years ago, 3 years ago.
Oh, did you? Okay.
Yeah, so I did go to Vegas. I think was it either 18? I can't remember what years, but it was a great time. Just going around, just networking, seeing a lot of the clients I've had and worked with, and just golfing, stuff like that. So it was good times.
It's really a one of a kind experience, and you can ask anybody that's been there. So
absolutely.
Well, thank you again for being here. And yeah, until next time, I'll say trade, profit, and make a difference. Take care, guys. Thank you.
Have a good one.
What the what? Who's and company? Is that your dog?
No, so my wife, my kids. No, I got